Hello, I'm Mark Abssy, Head of Indexing at Tematica Research, and welcome to the week ahead. So before we get into next week, as usual, we'll just take a quick look back at the past week, and because Monday is the 31st and the end of the quarter, we'll do a very quick recap of the quarter. And basically what ended up happening last quarter is that everything ended up going down. Well, that's not entirely true. It went up, and then it went sideways, and then it went down. And that in order was January, February, and March, right? Through the quarter, especially in March, Mag 7 tech was kind of not your friend, right? We saw NASDAQ Composite down 10.3%, the less tech heavy S&P 500 down 5.1%, and of course the Dow down 2.25%. Small caps, which usually kind of march to their own drummer, if you wish, down 9.3. So there's definitely some kind of poor sentiment out there. And again, I think if you look at the Russell 2000, a lot of that came in March, right? And specifically with consumer weakness that's been projected both in some earnings, but definitely in guidance as we come out of the earnings season with the focus on consumer companies. Now, what's interesting is that, well, there's, as you know with me, there's lots of things that are always interesting, but if you look at the market cap weight, S&P versus the equal weight, right, you look at SPY versus RSP, the Invesco equal weight S&P 500, RSP, outperformed the S&P 500, SPDR ETF by almost 3.2%, right? So both were down, right? RSP, the equal weight, was down about 1.96%. SPY down about 5.2%. So again, some weakness in both, but clearly, the cap weight driving a lot more of what's happening in that index. And indeed, when you look at sectors, right, 11 gig sectors, only 4 of them were down, but 3 of those 4 account for over 50% of the index, and 2 of those 3, which account for something like 40-something, low 40%, one was down 11%, the other was down 12%, right? So definitely, as we like to say, or used to like to say, the big stacks are kind of pushing the table around here, okay? Looking at other asset classes, gold, apparently is still the traditional hedge that everyone looks to, and that was up in the quarter, up about 16-17%, and of course just this past couple of weeks has been setting record closes highs pretty much every other day, right? Friday's close 3,056, right? Again, 3,000, gold at 3,000 was a pipe dream for a lot of gold bugs. It just means, frankly, at these levels that they're probably, digging deeper holes to put those coins in their backyard. But, gold up higher, hitting record highs. Volatility is interesting, definitely higher, about 25% higher than we had the beginning of the year. But in terms of the last couple of weeks, right, vol's kind of settled in around kind of a 20-21 handle. We did see it getting fairly high, 25, 26. It's come back a little, still elevated, right? Long-term averages for VIX are something like a 14-ish, maybe low 15 handle. So we're still seeing some elevated volatility here. And a note for anyone who is interested in buying insurance, i.e. puts, volatility, or Vega as it's called, is the largest component of option pricing. Okay, so as we go on, and if things become more volatile and we see volatility kind of marching up, buying options at high volatility levels can sometimes be misleading. And the reason why is because something called vol crush, and basically when there's a lot of uncertainty, volatility rises. And as things come to fruition and we know, then vol craters. Okay, so you could have a contract that, you buy for $5, but guess what? Maybe three or sometimes even four of those dollars are priced in with volatility being at an elevated level. So you could have a trade that goes your way and you made the right call. But the point of it is that once reality hits and we are certain, that 25, 26, 27 handle VIX vol that you bought your contract in, all of a sudden now, vol's trading at, back down to a 16 handle. You could even lose money on your trade even though you got it right. So if you are interested in hedges with options, please pay attention to volatility. There's plenty of online calculators that can help you map out what the option is worth now and what would that option be worth if volatility goes to 19 versus 21 or 22, or even goes to 17 or higher or what have you. So I don't know, that's my PSA about vol crush. I'll move on. When we look at this coming week, we do have a number of economic data events. Okay, first off, there's like 8 Fed chairs that are speaking. Not Fed chairs, but Fed speakers this week. 4 of them are actually happening on Friday. So it's going to be interesting because, we will see some more PMI numbers. We're going to get, of course, jolts and payrolls and unemployment. Expectations there, of course, is that, those numbers are not going to be looking better. Unemployment, I think, is expected to come out at like a 4.2% versus the previous 4.1. We are looking again at Friday payrolls, manufacturing expected to be cut in half from the last number, 5K to 10. Non-farm down considerably to 122 from 151. And then, of course, private non-farm down to about 120,000 from the previous 140. Okay. ISM manufacturing expectations are calling for something south of 50, right? And of course, if you recall, and as we've been saying, with these PMI numbers, 50 is your dividing line, right? So anything north of 50 indicates expansion, growth. Anything below 50 indicates some measure of contraction, right? And if you've been kind of playing along through this quarter, manufacturing had been lagging services for a while. It did kind of poke its head up above water for a little bit there. Seems like things are starting to pull back, right? And, of course, we know the reason why is not only the threat of tariffs, but tariffs themselves, right? So this week, April 2nd, right, the Wednesday, depending on your point of view, it's either, Liberation Day or some other day. Anecdotally, my wife and I were out to dinner the other night, started talking to a couple next to us, and I'm not saying this is everybody, but, they decided quite quickly that, the car that they needed to upgrade, that they would do it ahead of next Wednesday, and basically they made kind of a snap decision to just go out and buy a car that day. So I'm not saying everyone's doing that. I'm not saying that everyone has the means to do that, but what we might end up seeing are some more purchases pulled forward, not as much as we saw at the end of last year, but we might see some more purchases pulled forward, which would make kind of late March, early April figures, look a little better than they would have, right? I was trying to think about what else. Honestly, it's really just about tariffs, right? We've had the threat of tariffs, then we had a month reprieve, and then people started getting antsy about tariffs again, and basically, there really is no indication from the White House that they're interested in backing off at all. I mean, in fact, if anything, we've been seeing more talking heads, get on various shows and talk about how, tariffs are not a tax, tariffs are good, tariffs are this, tariffs are that. You know, we're gonna find out either way. Let's just put it at that, right? Um, you know, they certainly aren't helpful for the inflation picture. And of course, with that inflation picture comes expectations of Fed action or inaction. So, assuming that there are no last minute, last second deals that get cut, yeah, then the expectation is that, rates are going to stay where they are for a little while, potentially even a hike. I don't know. But the one thing which is interesting that we saw over the weekend was I think there was a B of A note that came out that actually talked about this idea of stagflation, right? Which, depending on your circles, is something that people have been either poo-pooing or warning about. But I think this is the first real indication that like I said, I think B of A put a note out, and then the website Axios picked it up and started publishing about it. So, more warning, more alarm bells, etc. Right, happening there. One of the things I also wanted to chat about briefly, of course, was the Tematica model suite, and interestingly, again on the quarter, we really had two of our models end up in positive territory, and one of them, as you would expect, was market hedge. The other one was actually our core holdings model, and so we're kind of pleased to see that the premise in our selection of those holdings seems to be holding, if you wish, right? If you'll recall, the description for core holdings model was, companies that are large enough that represent a good enough amount of U.S. economic activity, but are large enough to kind of not get, quote, not get pushed around by kind of near-term, macro events, right? And clearly that's what's happening now. There are macro events that are happening, but again, it looks like the premise of that strategy is holding up. So again, we'll see. We have one more day in the quarter, which is Monday. Not entirely convinced it's going to be a blockbuster day. I don't know how much more kind of buy the dip is out there. But we'll have to see what happens, right? Never say never. But honestly, just with the specter of Wednesday and with the specter of, yes, tariffs are going to happen. I don't see anyone's spirits being lifted on Monday to dig out of some of the quarter end declines that we've seen this so far this quarter. So I mean that's about it, right? We're looking at tariffs on Wednesday. I said we have a slew of Fed speakers. We're getting more updates on the employment picture. We're getting some ISM figures on manufacturing, and we'll be parsing all these comments to figure out what is next. Okay, thanks for listening. We'll see you next time.